We had in our program our great friend Jim Young, CEO of Union Pacific. But Jim yesterday came down with a little illness that caused him to have to go to the Omaha hospital. As Bob said, it did not require the filing of an 8K for those of you who follow public markets. But I want to bring up to the podium now Robert Turner, who's the Senior Vice President for Public Government Affairs for Union Pacific. He's been with the UP since 2000, and he is a terrific guy. We really enjoyed the visit last night. Formerly associated with Champion International, the forest products company. He's a native of Ohio. He's involved with the Nature Conservancy in Nebraska, and he's going to bring us a message today about the amazing impact that UP has on Arkansas and a real leading economic indicator of what our economy is doing when you look what goes back and forth in those trains every day, 24/7. Bob?
Thank you very much, French. When I was realizing I was going to be here today, I began thinking about your plight in all of this, and I remember a situation that probably all of us have been involved in. You're given tickets to a big show with a big star as the lead, and you go out to dinner and you go into the show and you sit down, and out of the program a little slip of paper drops out that says, "Tonight the lead role is going to be performed by someone you've never heard of, the understudy." While you're there, you're in the seat, you can't get away, so you're going to have to sit through it, and I think that's kind of my role this afternoon. But it is great to be here. Jim is a guy who's normally quite healthy, and he really feels physically crummy, but is sad that he can't be down here. It's been on the calendar for a long time, and he's really been anxious to do it. Now, here's the one slide the lawyers make me show. And I promise that if I say I gave you the forward-looking statement warning and told you that things I say may be in the category of forward-looking statements, and if you have questions, you should go to our website, or even worse, to the SEC. If you promise to answer yes, if anyone asks you that question, I promise I will not read this slide. Charles thought he had the tough slide. That's the worst. Let's start right here in Arkansas. We've been here a long time. Our company is starting its 150th year. This year, Abraham Lincoln created the company. There are very few companies that can say a president of the United States created them. We're one of them. And we've been around on July 1st for 150 years. But we're a big company here in Arkansas. As you can see, we've got about 1,300 miles of track. We have a good payroll here, and we're continuing to invest. Our average spend on capital is a little over $100 million. We've got $100 million in the plan for this year alone here with yard expansion, track expansion, all things that help businesses here in Arkansas connect to the global economy. At the same time, we're hiring people. Our company has about 45,000 employees. We've hired 27,000 people in the last 5 years. The baby boomers are retiring. We are hiring people, and we're doing it right here in Arkansas as well. In fact, our plan for 2012 is to hire about 4,500 people, and many of them will be here as well. Not on that list are 20 more projects to expand capacity here in Arkansas. I met earlier today with some of the folks at the Department of Economic Development, gave them the list. I hoped it matched up with what they knew. It did. That was good. But these are all projects where we're investing to support businesses in Arkansas to provide better service. The overview for our company is we're in the service business. We really are focused on that. We think that the mission we have in this world is to serve our customers, and we're trying to get better at that than we've ever been in the past. This is really our foundation. This is where we start with all our employees, where we're teaching them that if we don't have great customer service, if we don't operate efficiently, if we're not safe, if we don't care about our reputation, we don't have a company. And over the last 10 years, it's not been hard to make that case. As more and more namesake companies get into trouble in this country, we certainly don't want to be one of them. Last year was our best year. On any measure, it really shows that we've hit our stride and we're moving ahead with great success. As I said, when you're 150 years old, you've had almost everything happen to you. We're ready to have some good things happen to us, and last year was an example of that. As you can see, we had record operating income of $5.7 billion, which is up 15% over the prior year. We've had records EPS, we've had record cash flow, and we've managed to get our return on investment up to 12.4%, which is another record. We're committed to continuing to provide great service, doing it safely, being productive, and trying to do that in a way that gets real value to our shareholders. When you look at how we did it, these are some of the categories that we have kind of arbitrarily break our business into. The volume was up in all except intermodal. Intermodal are the boxes you see coming through, and part of that was a shift in our way of running that business. Part of it is the international intermodal was down year over year. But really what that shows is that our income, our volume is up across a lot of these categories. And when you look at that, this still is 15% below where we were at our peak in 2006. Our run-of-the-mill number that we look at every day are loads, keeping on a rolling 7-day average. We're today at about 170,000 loads. The peak number in 06 was over 200,000. We think this year it's going to be higher, but it's obviously dependent on a lot of things. As I've said a couple of times, safety and customer service are two codependent goals in our company. We've got a fabulous safety record. I mean, this is not only our employee safety, but it's public safety with crossings, it's derailments. We measure it in a variety of ways. These are record numbers for us. They're still not where we want to be. Our goal, obviously, is to have a year where nobody is injured. In our industry, actually, our safety numbers are better than those in grocery stores. Not anything against grocery stores, but the difference is in our world, an injury in the railroad is really unforgiving. It can cost you a limb, cost you your life. So we are on this all the time. On the customer satisfaction side, we've been surveying our customers for 30 years. We have embraced a system that Toyota uses to survey their customers. They told us when we started if we got into the low 80s, we would have done very well. We're feeling pretty good about 92. January actually came in at 94. I think it'll probably settle down a little as we go forward, but we think there's still a gap to close. Clearly, if you're the unsatisfied, in that case, 8 points on the scale, we've disappointed you. We don't want to do that. We want to move ahead. When you think about rail, almost everything in your life has been on a train before it comes into your life. We move enough coal to supply electricity for virtually every home in America. We move the cars you drive before you've driven them. We bring the parts to the auto assembly plants before they're built. We carry the stuff that builds the roads on which the cars operate. So it's really a big business. We did 1.2 million carloads of vehicles last year and 138 million tons of sand and gravel. So we're really connected to the auto industry. In Charlie's world, we move enough wheat to make a loaf of bread for every U.S. citizen for every day. And perishable products are increasingly moving from truck back to the rails as we get better and better with refrigerated transport. Fertilizers that make the crops grow, chemicals that make our lives safer, make it better. Trains are going to carry them, and we do it more efficiently than really any other form of transportation. This is one of the ways we kind of think about our business. We have the three big groups, consumer, food, and energy, and then around the outside, a set of kind of cross-cut external factors that we think will or could have some effect on our business, on our company, if we're not careful about it. When you look at the consumer piece, despite these charts you've seen about consumer spending, consumer debt rather, the spending has not been there for the last couple of years. And really, until it does, we don't see much of an improvement in things having to do with housing and a lot of the things in that construction area. When you get down to food, and for us, that's everything from, as you see, perishables to fertilizer to beer. We move virtually all the beer that moves from Mexico to the United States is on a UP train first. Our goal is to make sure it's all there when it leaves and when it arrives. And it is. We actually do pretty well with that. But as you can see, there's just a whole set of outside issues that could have an effect on these as well. On the energy side, we used to think energy is just coal. But over the last 4 or 5 years, it has really changed profoundly. Part of it's been ethanol. Part of it's been the move towards alternatives in the last 3 or 4 years. And finally, the whole shale play, and I'm going to talk about energy more in a minute, has really fundamentally changed the whole profile of our energy business as well. The government writes a lot of reports. I think everybody would agree with that. One of them is their National Rail Plan. This was an effort done to try to figure out, try to give some direction to federal policy and state policy over the future as to where the rails are going. This is an administration in love with passenger rail. We see that as kind of a threat because in many cases they'll get out a map and say, well, let's Oh, here's a line from Little Rock to Memphis. Let's run passenger rail on that. Who owns that line? We own that line. And so it becomes a challenge for how you do it safely, how you do it cost effectively. The core here is there needs to be investment in freight rail. When you look at some of the numbers we're going to talk about in a minute, more goods are going to want to move, they are going to move, and you want them moving on rail. So expanding freight rail is a critical part of what needs to happen in this country. This is private investment. We're not asking for government money to do it, it's private investment, and so it's easy for federal policy to take it as a goal. Sometimes it becomes a little bit harder to translate that policy into regulation and action. But in the end, the government is saying, and we agree clearly, that we need to have policies in place that will support the growth of freight rail across the country. Now, this is not to pick on trucks. Trucks are great customers. I'm sure there are people who are in the trucking business here in this room. But one of the ways we can grow together is to optimize the sort of sweet spot between trucks and rail. We are most efficient at long haul, call it 500 miles and longer. Trucks are far more efficient in short haul. So imagine a scenario in which trucks aggregate goods to a railhead, say within a 250-mile radius. The long haul goes by rail, and then they're disaggregated by trucks at the other end. There's a lot of room for growth for everyone in that kind of a model. What has to happen is service has to stay strong. We have to provide enough value that our customers will continue to buy our service at a level that allows us to reinvest. And we have to be sure that government policy doesn't get in the way to slow it down. This is some World Bank data that attempts to show the competitive value that freight rail in North America brings to the economy. No customers ever, and we have several here, I've met a couple of you today, no customers ever called us and thanked us for raising rates. If they did, we'd probably make them Customer of the Year and then question their judgment. But it's a fact that freight rail in this country is a competitive advantage when you look at it versus other countries. We have to be careful that this model doesn't get out of whack, because in the end, we want our customers to grow, we want our customers to invest, because that will be more business for us and give us a chance to grow. This is critical for Arkansas because it is a way to connect your companies, your business, your economy with global markets. This is I was going to call it an eye chart until we saw one of Charlie's charts a few minutes ago. This is actually very clear compared to some of those. Sorry, Charlie. This is an overlay of our system and our partners with other rails around the country. We're 32,000 miles. We're in 23 states. We've got a wide variety of products that we move. Candidly, we move almost anything that doesn't eat or drink. And it works very well for us. We're in the western two-thirds of the United States, and we're serving the faster growing parts of this country, so we think that really gives us an opportunity. In fact, if the US population grows to 20% to 2030, that's projected, that equates to 2.7 billion tons of additional freight that has to move somewhere. So we think that we're going to have a real opportunity with that. Port access is important. As you can see, we connect to the major ports on the Gulf, the major ports on the West Coast, and that gives us access to the global economy. We're the only railroad that has all 6 interchanges in and out of Mexico, and we connect into Canada as well. About 40% of our business either starts or finishes on another railroad. It can be a short line, it can be another Class 1. So it really is a business where the whole industry needs to be on the same page technology-wise, connected to the idea of great customer service so that we can all continue to operate efficiently and do well. Interestingly, about 1/3 of our business is international, goods that either start or finish in another country. If you look at Mexico, where we are a primary player, it's really a fast-growing opportunity for us. We moved almost $2 billion worth of freight last year in and out of Mexico, and it's really all kinds of freight. It's auto parts, it's finished vehicles, it's agricultural. It's a great and growing business for us. One of the surprising facts when you hear the criticism about cross-border trade is it's surprisingly balanced. Last year it was within a couple of percentage points of being equal between goods going from the United States into Mexico and goods from Mexico coming back into the United States. So there really are raw materials in the United States going to Mexico to be manufactured and coming back. There really are things manufactured in the United States that are being sold in Mexico. So it's been a very strong growth opportunity for us, and we believe it's going to continue to grow. Nearshoring, we see manufacturing moving from Asia towards Mexico. ought to be another great opportunity. Clearly, the country has challenges with security. You only have to do is pick up the paper and know that. But it's really, we think, an opportunity for us that will continue to grow. And while we're a big player down there, our hope is that that number only continues to grow into the future. So let's look ahead to this year and beyond. We don't provide specific guidance on growth by any given commodity, but we do kind of put them in these three buckets that show products that we think are going to grow a little faster than others. Clearly, minerals, petroleum are the big ones. We've got the ability to move any of these products anywhere on our system. So as long as we can have the resources in place, we can do about any of this. And so we try to figure out where to put those resources. If you go down the strong list, we think that the whole energy play is going to continue to grow. We think that the domestic intermodal, that's trucks off the highway, reflecting stronger service on the rails, is going to grow as well. Coal, we have several coal folks here from Colorado and Utah. It tends to be a higher value, higher BTU value coal. We think the market for that could continue to strengthen. Conversely, Powder River Basin coal, that's the biggest part of our coal business, we think is going to be a little softer. The mild winter has clearly had an effect. Our coal business is off about 5% in January. That's not as big as others have been off, but that's one that we really need a hot summer to kick up air conditioning, because that's been the big driver of coal. And then international intermodal will just be hard to see as that business continues to grow and is affected by new trade patterns. As manufacturing moves from China towards Cambodia, towards India, and maybe even towards eventually Egypt and Libya, you could see the Suez Canal taking on importance against the Panama Canal. The Panama Canal is clearly a factor on West Coast ports as well. So it's a changing dynamic. We think that most of the diversion from ports on the West Coast to the Panama Canal has already taken place. There's about a third of the business that you can make an economic case could move all water, and that's about where it is today. A lot of ports are very excited about what that means, but remember, the earth is round. If you come into the Panama Canal on the Pacific side, you are further east than Houston, Texas. So when you come through the canal, you've got a day steaming backwards to get to the Gulf. So will the Gulf ports take off with Pacific trade? Hard to see, but we're going to watch it, and obviously by providing great service across the land bridge, if you will, we'll continue to be a player in that. The ports of LA and Long Beach are the big drivers. They've got unbelievable challenges, not the least of which are the neighborhoods around the ports, the unions that are there, and leadership that really grew up in a world where they could have both, a lot of regulation and a lot of growth. The fact is the growth is kind of gone, and they're kind of wondering why. But in the end, they control their own destiny. If they get it worked out, it should be fine. Energy is going to be a big deal. Obviously, you're seeing it here. The chart earlier that we showed, that French showed of pipelines, and the Keystone Pipeline is in Nebraska, where we're based. Interestingly, that pipeline, when built, will move about 850,000 barrels a day. A unit train of oil is about 65,000 barrels. So it's about 12 trains a day, which is not a big deal in our world. Ultimately, it needs to move in a pipeline. Some of it will go in rail, but over the next few years, we think it's really going to be a fabulous opportunity. We haul the sand and pipe in for the drilling, then we haul the oil out afterwards. So it's really a business for us that actually is over $6 billion last year. We think it's going to be more this year. And even though it has a lot of feel of a bubble right now, the capacity we're putting in to handle that business is a 30, 40, 50-year investment. We'll be able to use that as we go forward if that market begins to deteriorate using other kinds of products. Here's just a chart that shows kind of where we're moving it. We don't really have much access to the Bakken up in the Dakotas. We get it from one of the other railroads, either in St. Louis or Chicago. A lot of it wants to go down towards St. James, Louisiana, where the refineries are. But this is a big, big opportunity, and we're spending a lot of money and a lot of effort to make that work. And ultimately, We think this is going to be good for this economy in this part of the world, and obviously a tremendous opportunity for us as well. Our industry needs capital. We're going to spend $3.6 billion on capital this year. That's up from about 3.3 in 11. About $2 billion of it is replacement spending. Tracks wear out, bridges wear out, all of which has to be invested. These are long-lived assets. We have a bridge over the Mississippi River that we have to replace. It's been there 100 years. It's on the books at about zero. It's about a $500 million spend. But we lose 6 hours. It's a swing bridge. We lose 6 hours a day of productivity when that bridge is open for barges to go through. We have 400 miles of bridges around our system. So we have lots of places where we're going to be spending on capital. We're putting another 200 locomotives on the fleet this year. These are highly fuel efficient. There's a good payback on them, but they're about $2.5 million a piece. We're going to buy about 1,800 rail cars to move, replace some older ones, but also to do some growth. So we have a lot of capital going into expanding the capacity. The blue on there is something called positive train control. After an accident in California 3 or 4 years ago, the government mandated an anti-collision system for freight rails. Technology has not yet been proven. The pilots are just getting started. Unfortunately, the current rules say it has to be in place by the end of 2015. It is a $12 billion unfunded mandate on the rail industry. Our cost alone, we estimated about $2 billion a year. Ultimately, our customers are going to have to pay for that. And the problem is, while it's always dangerous to talk about safety and cost and human lives, if you were going to spend a fraction of that in more productive other safety venues, you'd have a much greater opportunity for success. But in all of this, we have to have the returns if we're going to continue to make the investment. Our balance sheet's in great shape. As I said earlier, we had record cash flow last year, and that was after increasing our capital spend by about $700 million and increasing our dividends by $236 million. We have really benefited by bonus depreciation. That's kind of rolling off this year to some degree as it drops in half. But we are feeling good, obviously, about our balance sheet. Our debt to cap is a little under 41%. It's a little bit skewed. We paid off some debt at the end of the year that was due to roll off earlier this year just on some rates, and we'll probably replace that as we go forward. In our world, operating ratio is just the inverse of margin. So the lower, the better. And as you see, over the last 4 or 5 years, we've done a tremendous job of making ourselves more profitable. It is a important measurement. It's one we look at all the time. It gets compounded a little bit by fuel cost, because when you do the math, you have to overcome fuel. If you take the effective fuel out of 2011, we actually would have been 1.7 points better. We are targeting better numbers. Some guidance we have given is that by 2015, we're going to be in the 65 to 67 range. This is something that even when you get there, you just set a new target and keep going. That is the lowest operating ratio of any U.S. rail. The Canadian National is a little lower. They've got some structural issues, but we think we can catch them and do better as well. Obviously, if you aren't taking care of your shareholders, you don't have the chance to do much. And we have really made a lot of progress over the last few years in returning things to our shareholders. Between increasing our dividend 58% last year, by buying back stock, we purchased $2.2 billion worth of stock last year, and in fact, $8.5 billion since our program started a few years ago. We are doing a good job of returning value to our shareholders. Dividend growth and share repurchases along with capital are really the 3 ways we use our cash, and we think a balanced approach on all of that has served us well. Here's the proof statement. If you look at our returns, whether you look at 1 year or 15 years, we've done pretty well. Double digits every year, and better than the S&P 500 as well. We think the proven performance matters, but we also know that every record really just becomes a new floor for how you're going to perform better going forward and going into the future. So it really is a big ongoing effort, but we feel good about this. We feel our shareholders are with us, and it's really turning out to be a great time to be in the railroad business. One final subject. We win the green argument. A few years ago, there was a lot of debate in our company about whether this was relevant. You've probably seen the ads by one of those other railroads that talks about the ability to move 1 ton 500 miles on 1 gallon of diesel fuel. Those are the numbers that the railroads have. It's a great story. That's the equivalent of your SUV getting about 250 miles to the gallon. So who wouldn't like that? That's a great deal. The change in this dynamic is our customers are increasingly asking about this. They want to have a green story to tell, and by moving their goods from truck to train, it helps them with their own environmental story as well. So it's a increasingly important aspect for us as well. So when you wrap it up, here's what we're trying to do. We're going to take the drivers that are on this slide and keep working them very, very hard. We think we've got a great value proposition for our shareholders. We think we can be a great citizen. We think we can continue to hire people and provide great jobs. You've got a franchise that you can't create. You know, the whole debate about passenger rail is about real estate. Where are you going to assemble the corridors? You know, in China, when they want to do a high-speed rail, they get out a map, they get out a Sharpie, and they draw a line. In this country, we have property rights. It's a different deal. You aren't going to have anyone go out there and accumulate long corridors that will let you build an independent rail system. So we have that. We have it as an advantage. Our job is to protect it and then use it to great value for our customers so they can grow and we can grow as well. That's my pitch. We're going to take some questions. I'll be happy to answer them. And thank you very much for your attention. And again, I'm sorry that Jim Young couldn't be here. He really wanted to do this, and I'm sure I'll get, as soon as I get back and he gets back, I'll get at least as many questions from him about this as I'm going to get from you about what I just said. Thank you.
Have we got a question passed up? Melina, have you sent it up here? I'm going to start out with one while they're accumulating. On the ethanol issue, of course, the government let the duty on ethanol imports lapse at year end and ended the tax on ethanol, and yet we still have the mandate for production. Sort of both Charlie and Bob, would you reflect on that, and gives you a chance, Charles, maybe to make a further comment on ethanol.
We serve 78 ethanol plants. 70 of them are in the cornfields. 8 of them are forward, so the corn goes to the plant. Candidly, we've been surprised at how little disruption in the flow of ethanol has taken place since the turn of the calendar year. We thought there'd be a lot more. At this point, it's been reasonably steady. In our world, our customers tend to own the cars, and we move them. So we've got it's obviously something we watch. It's an important business for us, but it's been less disrupted than we thought, just thinking about it 6 months ago.
Charles?
Well, my comment would be, about a year ago, I made a speech to a group of southeastern cow-calf producers up north of Memphis, in a little town up there, and there were about 50 of them there, and I did a poll of them. I did a poll of these 50 cow-calf owners, and about 45 of them were farmers also. What happened in the process leading up to the ethanol program is that because many of the cattle people also are row crop farmers, the mother cow, the foundation of the whole beef system, got disenfranchised. And there's been a massive liquidation of the beef cow industry in this country, largely because of the economics of ethanol. Then quite often in these kind of situations, Mother Nature gets involved late in the game and tips the system over. And the drought across the southwestern United States has been truly monumental. And I had a genius from New York, you know they have a lot of them up there. I had a genius in my office from New York the other day, and he said, well, Mr. McBain, they had a drought almost that bad in Texas in 1950s and one that might have been worse in 1930s. I said, yes, sir, that's what the data says. I said, but sir, could I ask you one question? He said, yes, sir, Mr. McBain. And many of you hear all the promotion about black Angus cattle. And so I asked him, how many black cows were there, how many black cattle were there in the state of Texas in 1950? He didn't know the answer. I know the answer. There wasn't the first one. Now, because of the mania about the black Angus cattle, about 75% of the herd in the state of Texas is black. Here we get into a question of physics, not biology. Well, the biological footnote first. The worst thing that can happen to a cow in the reproduction process is elevated body temperatures at the time of conception. The black cattle couldn't take the heat. And on top of the liquidation of numbers down there, we have a reproduction catastrophe. So there will be a shortage of beef in the next couple of years, and it's largely attributable to the ethanol program.
We'll put Charlie down as undecided on ethanol, you think?
Well, we had a follow-up question on that, just, and again, for both of you, just based on the data and things you look at every day. Are you seeing now more and more alternatives to corn for ethanol production around the country in any place, or not any, or is there no measurable aspect of that yet?
We haven't seen any.
No.
Good. Here's one near and dear to my heart, and since I want on record that Mr. Turner is an active bicyclist at the Union Pacific, so here's a question to you. In Arkansas, are there any, and I assume they mean UP-controlled rail lines, that might be abandoned with a potential for trail conversion?
No. We talked about this a little bit at dinner. You know, there's great temptation to want to put bike trails, jogging trails next to trains. The problem is the fencing, the risk, keeping people away. And if you have a line that's going along and you put a bike trail on one side of it, you've in a sense disenfranchised your opportunity to grow on that entire side of your line, because you're never going to put a crossing across the thing. We have a lot of right-of-way that have gone into the rails to trails category, and I said we don't give much guidance, but I'll give you guidance. The first one of those we have to take back and put tracks on, I'm not going to be a part of, because I think it'd get pretty ugly.
That would be an ugly political position to be in, I think. Charlie, where do India and Indonesia, two large, obviously, companies that we didn't touch on in too much detail today, fit in your global thoughts on the subject of protein consumption and just the impact? Any added comment on that?
Well, the biggest problem we have in India is that they don't eat beef. India has got two problems. They've got a lot of strong attributes, but two problems. Corruption in government that's impressive even by our scales. And secondly, India lags far behind China. China may be overdoing investment and infrastructure, but India has lagged behind. Now, I know a lot of very, very smart Indians, and the English language is a great attribute. I think in the long term, I'm inclined to be very friendly to India. Indonesia, they can benefit from. As you look at Indonesia, the plantation system of agriculture is not a strong growth model, and they're still bogged down in that system. So I'm bullish on India long term, though.
We had a question from the audience. Is there an ETF on corn? And there is a corn fund. The stock symbol is corn. Impressive. C-O-R-N. And then there are two kind of broad-based ETFs that I think people follow. One is DBA, which is a commodity-based ETF that includes ag commodities, and also MOO, one right up your alley, Charlie, MOO, which is a broad-based sort of corporate ag component ETF that you might want to take a look at. Charlie, how do we, you made comments about the trade balance. Take a second and what's the top thing from a federal policy point of view that one would do to turn it in a different direction?
There are those that would argue, and I believe Michael Drury and I basically fall in this camp, that the G5, that is the G7 minus the two big exporters, Japan and Germany, this thing has gone on too far. The G5 is essentially unfixable without rebalancing China. These sustained trade deficits have run our debt up so far that it becomes a no-win situation unless you force the rebalancing in China, partially through bilateral negotiations, if such are necessary. Now, we believe on the constructive side of this I'll take just a second. We're having a conversation. We have two very bright Chinese guys who are our people. And so one of them's name is Jay, and I'm very impressed with Jay. I said, Jay, do the 10 guys or so that run China, do they really think that this maldistribution of income that's at a very progressed state, is this sustainable in an increasingly internet-sensitive world? He said, Charlie, they are not that naive. China realizes that they've got to begin to rebalance and begin to take the steps necessary to grow a true consumer economy in China, rather than growing on the back of exports. And I failed to elaborate this point. The reason China can't continue to grow on an export model is because we can't afford those exports any longer, because they're getting stacked straight into our federal deficit. They're not that stupid. They realize that. If China moves to rebalance, it'd be very difficult to be too bullish on the prospects for U.S. agriculture, and by the same token, it'd be difficult to be too bullish on the Union Pacific Railroad.
So in other words, you would see that trillion-plus trade surplus in China in U.S. dollars be used to build their domestic economy. Is really where Charlie's coming from. Instead of pouring it into sending the St. Patrick's Day trinket you buy at Walmart here. And we've seen this transition in other economies. It's a difficult transition. We've seen it throughout society with Japan, being the biggest case.
As Michael Drury points out, there is a model for that, and the model was the east to west expansion of the United States of America. Once again, compliments of the Union Pacific Railroad.
Right. They could do well having the golden spike driven in by the UP in Mongolia. Well, thank you all. We've come to the end of our program today. It was a delight to have you. We invite you to go to the website, check out the new page, register for the iPod, and you can also log in and get all the presentations that we went over today. Thanks for coming, and Happy New Year. Happy 2012.